Okay, we're here today with Bill Longbrake, Executive in Residence at the Center for Financial Policy at the University of Maryland. Bill writes a monthly letter called the Longbrake Letter, and routinely he speaks to me about recent economic and financial events. Today I'd like to touch base with you, Bill, about the recent events with the European sovereign debt crisis, and most recently what's happening with Greece. Now, as you know, earlier this week, Greece's Prime Minister announced a referendum for the plan that was created and agreed to last week to reduce their debt burden and also to help fix their sovereign debt problem. Now, the referendum call was largely unexpected. It caused multiple problems, a slight revolt within his own party, and also sharp declines in the markets worldwide. Now, how likely will the confidence vote pass this Friday to enact a referendum in January? And how is this going to impact the U.S. markets and economy?
Well, those are several questions, and let's come at them one at a time. Let me begin with just describing recent events. The plan that came out of the European Union last week had three parts to it, and one involved Greece and the other two involved other facets, which we can come back to in a moment. The one that involves Greece has to do with Greece has to agree to certain conditions before the funding to allow Greece to make payments on its debt becomes available. In two prior occasions, Greece's Parliament has approved those conditions, so it involved things like raising the retirement age, raising taxes, cutting government employees, all measures designed to reduce the size of the budget deficit and get Greece into a position where it actually can get its debt down. Unfortunately, the austerity measures that were required by the International Monetary Fund and the European Union have badly depressed the Greek economy. So GDP is down about 12% over the last 2 years. Unemployment now is above 15%. The Greek economy is doing very, very badly, and what's happening is that the debt to GDP ratio has actually gotten a lot worse than anticipated.
Because GDP keeps falling.
Because GDP keeps falling, so the denominator is shrinking and the numerator isn't going anywhere fast, and so the whole ratio is going up. Now, this is not a tenable situation for the long run. If the Prime Minister, George Papandreou, had done what he did the two previous times, he simply would have taken the latest set of conditions to Parliament and asked for approval, a vote of approval. But he decided, as you pointed out in your question, that he would take this to the people of Greece in a referendum. That surprised everybody. It came out of the blue, and it really does throw a monkey wrench into the total plan that's been arranged here, at least in terms of the timing of it. There's two parts to this. The Prime Minister is calling for a confidence vote on November the 4th, that's Friday, and it's not clear, as you pointed out in your question, whether he will win that confidence vote. The Greek Parliament has 300 members. The party, as of yesterday, with yet another defection, has only 152. So just a bare majority, and there's considerable disagreement among certain factions in the Prime Minister's party about whether this is a wise move. If the confidence vote is not sustained, what will happen is that there will be a national unity government formed and new elections called. New elections probably be held in December. Between now and that period of time, the national unity government basically would not be able to commit Greece to anything, so that we go into an extended period of no decision. So that's what's pending in Greece, and we'll know on Friday at least the next steps. So maybe next I go back and talk to you about the other two aspects of the plan. The concern all along with the European sovereign debt crisis has been the potential for a run on banks and contagion to other countries in a way that becomes unstoppable and creates a crisis of the sort that we experienced here in the United States in 2008, that culminated in the Lehman Brothers collapse. And so right now, Greece could be the Lehman Brothers of this particular crisis. And that risk is definitely, with this call for referendum, has escalated. What the Europeans tried to do in their plan last week, and which the market, at least at the first blush, seemed to like a lot and thought it was terrific, and the stock market had a tremendous rally, is to what's called ring fence the banks. And that is to make sure that if there is a default on Greek debt, and possibly on the debt of other countries such as Portugal or Ireland, that the banks that hold this debt have sufficient capital to absorb losses. Pretty much all analysts had concluded that that was not the case, and so part of the plan last week was to require the banks to increase their capital, and there's actually a schedule that's been developed by bank and by country, and it totals 106.4 billion euros, very precise. All right, unfortunately that amount is probably at the low end of the range that experts have said is required. The International Monetary Fund itself suggested 200 billion is probably needed, and others have pushed that figure up even further. Then the other situation is, well, what if there is further deterioration in the situation in Italy or in Spain? Those two countries, their debt has been under pressure. Their yields have gone up considerably since July. And the concern there is if there is a run on that debt, maybe they will need a bailout just like Ireland, Portugal, and Greece have needed to date.
Quite possible.
Yeah, they're much bigger countries, and if that comes to pass, there's simply not enough dollars in the European Financial Stability Facility at this point to deal with that kind of situation. So the third part of the plan that was released last week is a very vague promise to increase the size of that facility. And I say vague because there were no specific details as to how to do it, only a commitment to do it. So that's kind of the three pieces.
Now, how effective would these three pieces be, given the fact that you even mentioned, hey, the amount of capital that the banks are to increase, it isn't really meeting the mark of what analysts say are needed, and that the buildup of the EFSF is very, very vague at this point. So how effective do we expect this plan to be if it's even enacted?
Well, so that brings us back to why is the Greek situation important? Because first of all, it will take time, quite a bit of time, to put these two pieces into place, the recapitalization of the European banks and the increase in the European Financial Stability Fund. Not a matter of weeks, a matter of months. And part of the reason I say that is, again, the details have to be hammered out in the case of the Stability Fund, and all the 17 parliaments probably will have to ratify that. And just to turn the clock back a little bit, when there was a similar agreement done in July, it took until early October for all 17 parliaments to agree to it. So that's a long timeline, and the risk here, and this is where Greece comes into play, is that if something doesn't go according to plan, and Greece is not going according to plan right now, then it could all blow up because the defense mechanisms simply are not yet in place. All right, so let's dig a little deeper on the bank capitalization. The bank capitalization is structured as voluntary. What that means is the banks have until next June 30th to increase their capital to 9% core capital equity ratio. But they are permitted to figure out how to do that. And a lot of analysts think, well, the easy road and the one that's least painful from a shareholder point of view would be to shrink their balance sheets. So you get to the 9% ratio by lowering the denominator.
Rather than actually raising more capital.
Right, and it would be better to raise more capital, but given that it's voluntary, what would you do? Well, to shrink your balance sheet, think about that for a moment. What does that mean? It means you're not going to make new loans. It means you're probably going to call in, you're not going to roll over loans. And those that understand this say that's going to result in an acute credit crunch, which will have negative impact on the economy and probably accelerate the downturn that's already beginning to show up in the European economy. Recession. Well, again, what does recession do to GDP? It
shrinks it.
Shrinks it, and debt's still up here, and so the debt ratios of countries like Spain and Italy will only go up. So that's not a very good situation, and what it does is it leaves in place a lot of uncertainty as to whether the banks would be ready. Now, if you have an event of default in Greece, and let's talk about that for a moment, the Greek 50% haircut on the debt is voluntary. Now, if you're holding the debt, would you choose to take a 50% haircut? Well, there's going to be incredible pressure on you. When they did the similar thing in July, it was a 21% haircut, if you remember. And there was a statement at that time that 90% of those private concerns holding the debt would volunteer. Right?
Right.
There was no similar statement this time. No 90%, no nothing. And so it's not clear at all how they're going to get to the 50% haircut. The reason that that's important, that it's voluntary, is if there is an event of default, then the Greek government technically is bankrupt. It triggers credit default swap requirements and all other kinds of nasty things. So the Europeans want very hard to avoid technical default on Greek debt.
Now, going back to the referendum, why call the referendum now? Why not have done it, you know, in previous rounds of previous plans? Why wait until a few of the bailout funds were released already?
Well, calling the referendum is purely a political move on the part of the Prime Minister. Prime Minister right now is being criticized from within his own party, from the opposition, and publicly. The reason for the referendum would appear to be simply to ask the Greek public to affirm the direction in which Greece is going, which is to stay in the European Union and do what is necessary, which means approve these austerity measures, even though it's very painful. And that's what the Prime Minister is asking for. Simply to have Parliament approve it without that kind of backing leaves him and his party very vulnerable to ongoing criticism and so forth. So then it comes back to, well, what's the likelihood of a referendum being approved? Well, first of all, you have to get past the confidence vote. If the confidence vote fails, then there's no referendum and we're into new elections. If the confidence vote is sustained, then you will have a referendum probably in January, and then you have two outcomes. Either it's approved or it's defeated. If it's defeated, which seems more likely than not right now, then you're back to new elections, except you're doing the new elections probably in February rather than in December. Get a new government has to go all through this again, and see what's happening here is time is extending out, and time is not a friend of this situation. No. If the referendum is approved, you're still sort of in the same situation. Yes, you get the government to approve the situation, but you still have these other problems with the debt of the capitalization of the banks and the European Financial Stability Facility.
Sure. Now, can you go through, you started on this path, I think, can you go through the different scenarios that could happen, especially to the world markets and not just within Europe? Right. Because as we know, and as we've seen yesterday, what happens in Greece and Europe usually percolates back out into the world markets.
All right, well, the first thing is to understand that the European economy is about 30% of global GDP, so a significant negative in Europe that leads to recession will have impacts throughout the entirety of the global economy. So the U.S., for example, there would be a reduction in U.S. exports to Europe simply because demand is lower. The euro relative to the dollar probably would fall a lot. That would make the U.S. a lot less competitive in global markets, not just Europe, but elsewhere.
Right.
And then you have on the financial side, there's about $1 trillion in money market funds that hold European bank paper, and it's about 40% of the total investments of those funds. And if the banks come under pressure, which is not an unreasonable bet at this point that you could get a run on the banks, that will create some issues for the U.S. We actually already seen a little bit of what might happen in the failure of MF Global, which had huge investments in Spanish and Irish and Belgian debt. And the debt actually in that situation is probably okay, but it was just the risk and the perception of risk led to a liquidity event and a run on MF Global that it could not survive.
Right.
But that's just symptomatic of the kinds of things that could happen in the U.S. The U.S. banking system has very little European sovereign debt, so on a direct basis there isn't much of an exposure there. But there is a larger exposure to the European banking system more generally, not sovereign debt, but more generally to the tune of about $1.2 trillion. So the point would be, Michelle, is the world is so interconnected now, both in terms of exports and trade and so forth, and also financially, that a setback in Europe would have ramifications across the globe. Those ramifications would not be positive, and the risk is that they would feed on each other and create a much worse outcome.
Right, absolutely, absolutely. And just to wrap up here, as we know, we're going into the next 2 days of the G20 summit. Now, how likely is it that these discussions are going to be changed given the latest events in Greece? How do you expect the other finance ministers to weigh in on the situation, given what you just said, you know, the interconnectedness of everything?
Well, first of all, a tiny little matter, but technically very important, is that the 8 billion euro payment that Greece is to receive out of the current arrangements, if the Greek Parliament doesn't approve the new arrangement, that 8 billion is in limbo.
Right.
Yet the payments are due, and that becomes, if they don't make it a technical event, a default. The IMF legally cannot make their share of that payment unless, so there's a problem there, and at the very least they're going to have to, they being the ministers, are going to have to figure out how to deal with that short-term problem. I'm sure they'll figure out a way to do it. It's not that large amount of money. Beyond that, then what they've got to do is accelerate the recapitalization of the banks and the European Financial Stability Facility restructuring. And accelerate, by that I mean they have to come up with definitive plans and then a time schedule to get it done. Mm-hmm. If they don't, the market is going to lose confidence and watch out.
And we've seen them lose confidence, and we've seen the effects of that,
the
especially
whole
in the past few
situation is
days.
incredibly fragile at this point, and the potential for contagion is very high. It's not a foregone conclusion that's going to happen, but it is very, very high at this point.
Great. Well, Bill, that wraps up my questions for today. Thanks so much for joining me, and we will certainly keep a close eye on the situation.
Okay. Thank you.